All right. Today we're going to turn to talking about corporate taxation. So far, we're talking about the effective taxes on people. Now we're going to talk about the effective tax on corporations. My most important announcement today. Well, first of all, music recommendation they called Polls. The last concert I'll be going to this year is next Saturday night at Roadrunner. And so you should check them out. Good rock show, indie rock show. Big announcement is please do your course evaluations. Those are important. I teach this course. I'll be teaching this course for many more years. It's a classic public good. It does you no good. Take time in course evaluations, but it helps out future generations. So please take the time to do course evaluations. People you know in class here or attending class, or in this class, please remind them as well to do the course evaluations. Yeah.
Given the nature of this class, are we allowed to get positive externalities from doing it?
No, there's no. Well, I mean, unless you can. Yeah, it's hard to measure. I guess you'd have to see if the course is better next year, and they have to talk to your friends take it next year and somehow tax them for the improved course. But there's an attribution problem because it might not have been your recommendation to make a difference. So I think it's gonna be pretty tough. I just got you public this. Okay, so today we'll talk about corporate taxation. So we've got to start with what are corporations? Okay, corporations are basically organizations of production, where basically the key feature of corporations is that ownership is separate from control. That basically the biggest corporations and the set of people who own it are not necessarily the set of people who actually make the decisions to run. Okay, corporations typically have shareholders. And shareholders are the owners, whereas managers are the ones who make the decisions. Now, managers typically have stock. Some stockholders are managers, etc. There's some overlap, but there's some separation of control and ownership. That's one feature of corporations. The second feature of corporations is limited liability, which means that you can't lose your personal wealth if the corporation goes bankrupt. So about 80% of all production in the economy is done by corporations. About 20% is done by non-corporate entities. Non-corporate entities are things like your doctor's office. Okay, the doc sometimes they're corporate, sometimes they're not. Or me as a consultant, I do some economic consulting. I'm a non-corporate entity. I'm not a corporation. I get the ownership and management of my little economic consulting things I do. In that case, that means that if I do something bad, I can be sued for everything I'm worth. Okay. If I have a corporation, they can only sue me for the value of the corporation itself. So limited liability is obviously very valuable as a protection against things going wrong in your production. Now, there's two types of corporations. There's S corporations and C corporations. The big difference is how they're taxed. C corporations are taxed by the corporate income tax. S corporations are taxed by the regular individual. So we're going to focus today on C corporations, which is the major form of how goods and services are produced in America, through C corporations. Every big company you've heard of is a C corporation. Now, the key feature of corporations and a key focus of all the field of corporate finance is that the fact that shareholders and managers are different people, overlapping to some extent but different, leads to what we call the agency problem. Which is that basically the set of people making the decisions for a firm, may not be profit maximizing, because since they may have a set of interests that deviate from the interests of the owners. The manager's preferences may not exactly equal the owner's preferences. And as a result, you could end up with managers not making profit maximizing decisions without any other market failure, just standard self-interest. Yeah.
Is the agency problem separate from the principal agent problem?
It's the same thing. Same thing. So basically, this is the standard. The example I like to use. I use it in 1401. So apologies, you've heard it again. It's an example of, let's say I'm a manager I'm the CEO of a mid-sized company, and I don't have my own private plane, but all my golf buddies do, and they say, "Ha, you loser! You don't have a private plane. You're not cool." And I feel really upset about this, and I want a private plane, but I've crunched the numbers, and it is not profit maximized for you to have a private plane. But if I crunch the numbers differently and assume that I would always take the single most expensive commercial flight between A and B on every trip, it turns out it would be profit maximizing to have my own private plane. Now, I'd never take the single most expensive flight, but when I do a PowerPoint presentation, it's really fancy, and I show columns showing what it adds up to and say, I will save money with a private plane. The owners don't know that I've done that. The owners aren't going to go through and check the cost of every single flight and check my math. They're gonna be like, well, this guy manages a company. He says he needs a private plane. He says it saves money. Let's get him a private plane. So that's not profit maximizing, but my utility includes this, not getting laughed at during my golf game. So as a result, I do something which is not in the interest of the owners. Okay, that is the classic agency or principal agent problem. Okay, and this shows itself in the sort of outrageous compensation we often see for CEOs. For CEOs who have very bad performances and still get massive compensation. Now, the CEOs will argue, well, we get very high compensation because we're extremely skilled and talented. It's not that we're just overpaid, but there is a lot of evidence to the contrary. One of my favorite studies is a study that looked at CEOs of oil companies. Now, what drives the profitability of an oil company is a lot of things you do, but primarily the price of oil, over which your company has no control. Yet if you look at the salary of oil CEOs, it goes up dramatically when the profits go up just because the price of oil went up. Now, clearly, they had nothing to do with that, and yet they're paid a lot more. That clearly suggests it's not about them particularly skilled, but just about sort of general agency problems. Okay, so that's the key issue that corporations face. The other key issue is, how do corporations finance their investments? Corporations make investments. Think of a company, make an investment decision. How do they finance it? And that's discussed in figure 24-1. So suppose a firm wants to finance an investment. They have a new investment opportunity and they want to finance that investment. Well, the first they could do is they could just use funds from what's called their retained earnings. Firms have money sitting around. You've heard about Apple sitting on their $30 trillion, whatever is cash stockpile. They can just use that money to make the investment. Alternatively, they can finance the investment. And they can finance the investment, roughly speaking, in one of two ways. One way is by issuing bonds, or what we call debt finance. Okay, if you issue bonds, then basically what you do is you borrow money from bondholders, and over time you pay them back through interest payments. On the other hand, you could issue shares of stock. You could say, I'm going to sell a part of my company in stock. If you sell stock, then you pay the stockholders back in one of two ways. One is you can pay dividends, which are regular, typically quarterly payments that are sent out to every stockholder. The other is by just having your company get more valuable. And then when they sell your stock, they get a capital gain. Okay, we're going to come back to this later, but this is basically sort of the diagram of how firms finance their investment decisions. Let me mention one other thing that's very important. The last lecture was awesome because you guys were super engaged. So I really appreciate that. Please continue that level of engagement. This is a complicated topic and a topic that I imagine will be relevant to many of you in your future lives. So please feel free to ask questions as we go along. Okay, I want to ask the first question, which is, why have a corporate tax? I mean, after all, why don't we just, at the end of the day, if you look at this figure 24-1, at the end of the day, everybody gets the money. The money comes out in either dividend payments or interest payments or capital gains. Why tax the corporations too? Okay, and there's really two arguments for why, not super compelling, but relevant arguments for why we tax corporations as separate entities and don't just tax the capital owners themselves. That is the question. Why don't we just tax the people who receive the capital? Why do we tax the corporations themselves? There's two reasons. The first reason is sort of theoretical, which is that theoretically, the optimal tax is a pure profits tax. If you could tax the pure profits of a firm, the economic profits, that would be optimal. Why? Well, think about it this way. Any firm that maximizes pi also maximizes pi times 1 minus tau. So there's no distortion, right? If you just tax profits, if you literally say, I'm going to take 30% of your profits, I don't do anything differently. Okay, I still want to maximize profits. That's still the best thing I can do. So that's why you'd want to tax corporations. Now, the problem is we don't measure economic profits. We don't know how to tax them. So in fact, that's sort of a silly argument because we don't really know what pure economic profits are. And we'll talk about the difficulties in actually measuring profits, but that's sort of one theoretical motivation. I would say the major real motivation for why we tax corporations is this very bottom blue arrow in the first column, which is that if we didn't tax corporations, retained earnings would never get taxed. Corporations have huge amounts of money they make that they hold on to. If we never taxed it as the corporation earns it, that money would never ever get taxed. Okay, it just comes back to our issues in chapter 22 and 23 about inside buildup and firms, and the PDV of tax revenues. So basically, that's the only way we can get at taxing retained earnings. Okay. Now, how does a corporate tax work? Well, there's a simple tax. The corporate tax is a simple function, which is that the tax you pay, corporate tax, is your revenues minus your expenses times the corporate tax rate TAW minus credits. So I want to talk about each of these elements in this formula. Revenues is easy. That's just what you make. Not very controversially measured, at least in the traditional sectors. That can be a little bit tricky with, in the new economy, but generally revenues is not a lot of controversy about how much money firms make. You measure P, you measure Q, you're done. Okay. The tricky thing is expenses. And expenses is tricky because expenses are of two types. There's flow expenses, like hiring workers, where every period you have to pay again to hire a worker, or rent on a building, where every month you pay rent. And then there's stock expenses like buying a machine, okay, which is a fundamentally different thing. And so what we do is so basically when we do expenses, we have a set of flow expenses, wages, interest payments you pay in your debt, rent, etc. There's a set of flow expenditures that you deduct. But when it comes to investments, you get to do something called depreciation. Depreciation is a way of turning a stock into a flow, which is we actually allow you to deduct a flow by essentially allowing to deduct the cost of the machine over time. Okay, so let me explain what I mean by this. Let's start with the concept of what is the idea of this is the following. When I hire a worker for a year, I'm renting the service of that worker for a year. If I buy a machine and use it for a year, it's the same as renting that machine and selling at the end of the year, right? So if I buy a machine today, use it for a year, let me back up. If I buy a machine today, use it for a year, and then sell it, the difference between those two is the cost of using the machine for a year, right? That's the concept of economic depreciation. It's turning a stock into a flow. Is basically the flow is how much I spent that year in using the machine. And that's the concept of economic depreciation. We want to measure how much you used that year of the machine. So in principle, this is easy to measure. You would literally say every time you buy a machine, after 1 year, you would measure what it's worth. And the difference would be what you get to deduct as spending on the machine. So if we had perfectly fluid markets in all machines where every year, every machine was priced at the end of the year, as if you could sell it, then we can measure economic depreciation. Of course, that doesn't happen. So what we do instead is we approximate it through allowing a depreciation allowance. A depreciation allowance, which is a schedule the government makes up that approximates economic depreciation. Okay, let me give an example of how economic depreciation will look if you could really do it right. Great example is computers. There's a great study of economic depreciation of PCs because the PC market is very thick at all durations of PC. People are selling used PCs at many, many durations. So you can literally measure what's a PC worth 1 year later. So you can measure true economic depreciation. And what this study finds is that it's essentially 50% per year. That is a PC after 1 year, it's probably a 10-year-old study. I don't know if it's true still, 15-year-old study. A PC after 1 year is worth half as much. A PC after 2 is worth a quarter as much. After 3 years, 12.5%, et cetera. Here's what's very interesting about that. The word depreciation implies physical breakdown, but depreciation is much, much more than that. In fact, physical breakdown accounts for almost none of the depreciation of PCs over a year. What accounts for it is the fact that newer models have come along that are better at the same price, or new softwares come along that you can't use unless you buy a new PC. Essentially, your PC has depreciated not because it's broken down, but because it's essentially worth less because better products are now available a year later. Okay, so depreciation is not just about physical breakdown. It's about literally the reduction in value of the good over time, which can come from many channels. Okay, so basically that's what economic depreciation is, but we approximate it through what we call depreciation allowance. So for example, the typical depreciation allowance is what we call straight line depreciation allowance, a straight line. What that means is we say, look, based on engineering estimates, we know this asset lasts X years. So we will let you deduct from your tax every year 1/X of the price of the good. So let's say we know you spend $1 million on something, we know it lasts 10 years on average. So let you deduct 100,000 every year. Basically, the last 10 years, we'll assume you're using it up equally over the time you have it. The problem is, as the PC example shows, it's probably not true for most goods. Most goods probably depreciate very rapidly and then maybe more slowly over time. So often what they will do is they'll have what they call accelerated depreciation, where you are allowed to deduct more of the good up front. Like for instance, an exponential function, like for PCs, will be accelerated. You get to deduct 50% the first year, then 25% the second year, then 12.5% the third year. So it'll be an accelerated depreciation schedule. Why do firms care? Let's say you're buying an asset and you have a choice of a flat line, straight line depreciation schedule, or accelerated depreciation schedule. Why would a firm care? Why would they prefer one to the other? Yeah. Right. So which is better for the firm?
The higher down.
The accelerated, because we want to pay taxes later, so we want bigger deductions today. This is a deduction. We want a bigger deduction today, so accelerated depreciation is better for the firm. The PDV. So essentially what we want to think about, we're going to talk about the math this in a few minutes, but basically we want to think about what's the present discounted value of the depreciation deduction you get. Think about buying, when you buy a, I don't know if any of you looked at, like, I don't know if it deals with fridges, but fridges, they have like these environmental ratings. You buy a fridge and it has like on it, like, here's how much you'll save on electricity every year. Think of every investment good as having a tag like that on it, which is here's the PDV of the depreciation allowance that comes with this good. Okay. And the more accelerated depreciation, the higher that PDV is. In the limit, we can allow expensing. Expensing is the ultimate form of accelerated depreciation. That's just deducting the whole cost of the good the first year. So the limiting case of is literally saying you get to deduct the whole cost of the investment in the first year. That's the most rapid depreciation. That's almost certainly never economic, right? It's hard to imagine. I mean, you need a really sort of fairly intensely destructive production process to have an investment good be completely worthless at the end of the year. Yeah.
So don't you also have like agency problems with this? As if I'm a new CEO coming in, I want to like look like our expenses are low, so I might pay things straight line instead of.
Great point. It's not up to you. It's up to the government. The government, there's this enormous book, which really every fucking little category of investment, they tell you how to depreciate it. I mean, like, lathes being used in production of this kind of textile, for this kind of duration, here's the schedule. It's not up to you. Yeah.
Is this written by the executive branch or the legislative branch?
This is written by the executive branch. This is a tax regulation written by the executive branch. Okay, so that's question. Yeah.
Yeah, for like expenses for like buying machines, for example, why not just treat it like consumer tax at 7% when you buy it and include it?
Say it again.
Like when like companies say buy like a deep fryer or something, why not just do it like if I go and buy like
why don't you just impose the sales tax?
Yeah.
Well, because the idea is that basically that would have nothing to do with the corporate. I mean, basically, how would you set the rate? I mean, you could set the rate at the corporate income tax rate, and then that would be expensing. So if you treat it like a sales tax and set the rate of TAW, then that's expensing. Okay. So that's this part of the equation. The tax rate, the corporate tax rate is basically a flat now 21% tax rate. There's a little bit of progressivity for very small businesses, but roughly speaking, it's a flat 21% rate. This is a flat tax. Used to be 35, now it's Donald Trump. The Trump administration lowered from 35 to 21, and we'll come back and talk more about that. Okay. So it's a flat, actually it's now flat 21 for everybody. It used to be slightly progressive up to 35, now it's a flat 21 for everyone. And then finally, there's some tax credits, just like the individual income tax has credits, the corporate tax has credits. The most famous of these is called the investment tax credit, which was a credit that's been in various periods in our history. We've essentially allowed you to have a credit against your investment. So for every dollar you spent in investment, if the ITC was 10%, then in addition to all this, you got a dime back for every dollar you spent on capital goods. So it's an additional incentive to invest. Besides depreciation, as an extra bonus. Okay, was the investment tax credit. Obviously, it's worth more because it's a credit at the end. It does not multiply by TOT. Okay. Questions about how this works? Yeah. They lose money. Yeah.
Yeah.
Absolutely. Corporate taxes are negative for a huge share of the corporate economy. And then what you have, and then once again, as we talked about last lecture, there's limited loss offset. So if they lose money, they're allowed to take some losses this year, but then there's what's called a loss carry forward, where essentially if you lose money, you're allowed to carry it forward. Like basically, I think you're getting to the edges of my expertise, but imagine you can only deduct like $1 million in losses. I think you can carry forward those for 7 years. So if you lose like 10 million, you're never going to deduct the last 3 million, but deduct $1 million a year for 7 years or something like that. So some loss carry forwards that allow you to spread that over time. But if you lose a huge amount of money, you'll never get to deduct it. Does that make sense?
Yeah.
Other questions?
I guess I would just follow up.
Consistently operate a loss, and that's called tech, right? That's called, and basically that's why the tech sector doesn't pay taxes. Okay, so what I want to talk about is a couple economic features of the corporate tax. I want to talk about incidence and efficiency. Come back to chapters 19 and 18. Let's talk about incidence. Well, what's the incidence of the corporate tax? Well, let's go back to our basic general equilibrium tax incidence theory that we talked through in chapter 19. If I levy a tax on corporations, okay, and let's say all goods and services are produced by corporations, and let's say people can only buy goods domestically, then what would be the incidence of the tax on corporations? If all goods are produced by corporations and there was no imports, what would be the incidence of a tax on corporations? Who would bear it? Yeah, consumers, be an elastic demand for the corporate sector, right? The corporate sector could raise its prices and consumers would bear it. Now, in practice, that's not quite true because A, as I said, about 20% of goods in America are produced by the non-corporate sector. And B, we have imports and exports. But by and large, we think in the short run, a lot of the corporate tax would be borne by consumers. The rest would be borne by firms. Now, once again, by firms, we have to ask, well, how much by capital, how much by labor? In the short run, capital's pretty fixed. So we think mostly by capital. In the longer run, we think capital's pretty mobile, whereas labor to the corporate sector is pretty immobile. I mean, you could move to the non-corporate sector, but you're not leaving America. So at the end of the day, we think probably in the short term, some will be born in higher consumer prices, some will be born in a lower return to corporate capital, and the long run, more of it probably be born in lower wages. Yeah.
Could you clarify the difference between corporation and firms again?
Corporations are firms. I'm using them interchangeably. Okay, except some firms are non-corporate. About 20% of goods are produced by non-corporate firms. So that's why there's still some labor mobility. If you cut wages, I go work in the non-corporate sector. So labor's not perfectly labor's perfectly honest with respect to living in the US, but it's not perfectly honest with respect to the corporate sector because there is a non-corporate sector. So workers won't bear all of it. But you think in the long run, if you had to guess, you'd think some by consumers, probably you think the party that bears the least of it in the long run would be the capitalists, right? Because that's the most mobile. What's ironic is you look at public policy discussions of corporate taxes, it's all about soaking the rich. It's all about got to rate corporate taxes to soak the rich. And basically what a lot of economists say is that is not what's going to happen. And that was the fundamental argument made for the Trump corporate tax cuts, was that basically this is a way to get more money in workers' pockets. Because by cutting the corporate tax rate, the long run wages would rise. Yeah.
Okay, so do corporations at the moment, do they tend to actually pay the whole tax, or do they tend to get loopholes?
I'll come back to that. So basically, so essentially the question is, well, what is the evidence on this? And the evidence is that if you look at the non-consumer part, it looks like it's about 50% capital, 50% wages. Seems to be the best estimates we have, but with a large confidence interval. So it is true that a higher corporate tax does penalize capitalists, but it also does penalize workers. Both things are true. It looks like about 50-50 split of the non-consumer portion of it. Okay? That's the incidence part. Now let's talk about the efficiency part. The efficiency issue is that we like investment. Investment causes growth. We like building the capital stock in America. So the question is, to what extent does the corporate tax deter investment? That'd be the efficiency cost of the corporate tax. The equity gain is at least half of it's borne by the rich guys. The efficiency cost is it could deter investment, which ultimately leads to growth. So we want to walk through the economics of how a corporate tax affects investment. So let's imagine that every dollar you invest in a machine yields MP sub K cents of return every year, the marginal product of capital. So every dollar investment yields MP sub K cents of return each year in terms of revenues. Okay. And let's imagine further that there's the depreciation of investment delta, we'll call it 0.1. Let's say if there's a 10% rate of depreciation, that is your machines depreciate at 10% a year. Let's just call it physical depreciation to make life easy. Okay. And let's say that to get your machine, you're not going to buy it of retained earnings, you're going to finance it. You're either going to issue bonds or you issue new stock. Well, if you finance investment, you've got to pay the people who are financing it for you. Let's take a simple case of bonds. So in a simple case, I'm going to finance a new investment out of bonds. Well, I've got to pay interest on that. And let's say that I have to pay interest at a rate rho, which we'll also call 0.1. What that means is every year for the dollar that I'm using to buy the machine, I got to pay 10 cents back to my bondholders. Okay. So basically, every year for a $1 machine, it's costing me 20 cents in annual flow. 10 cents because the machine's literally worth 10 cents less, and 10 cents because I'm paying my bondholders 10 cents. So $1 I spend in a machine every year, if I buy a $1 machine, that's an annual obligation of paying 20 cents a year. So should I buy the machine? Well, that depends on what the marginal product of capital is. So go to figure 24-2. Figure 24-2, we have in the x-axis the quantity of investment, on the y-axis dollars. What we're saying here is the marginal cost of flat 20 cents. Each dollar of machine costs you 20 cents a period. The benefit is the marginal product of capital, which we know is diminishing. Okay. As a result, you have a diminishing marginal product of capital intersecting a flat cost, and that gives you an optimal amount of capital K1. And that's how firms choose how much to invest. They compare the marginal product of capital, which is the benefits of investment, to rho plus delta, which is the cost. And they choose some optimum where they intersect. And absent taxation, that is optimal investment. Okay, firms will invest until the marginal product of capital. And here's the key intuition. Remember, this is going to get confusing if you don't remind yourself. More investment means lower marginal product. So what that means is your initial investments are going to have a high return. But as you invest more and more, eventually, you're going to get to the point when you go to the right of point A, the marginal return of the next dollar of machine is less than 20 cents. So you don't want to invest that next dollar in machine. At point A, the next dollar of machine literally is 20 cents in revenues. That's your cost. So that's the point at which you want to settle. Okay. Now, what does the corporate tax do? Well, imagine for a moment there's no deductions or credits. Let's just say we're going to have a corporate tax, which is going to tax your revenues at a rate tau. Okay. We're going to tax your revenues at a rate tau. What that means is that your MPK is now MPK times 1 minus tau. You now get less benefit from each dollar of investment. So you shift to something like figure 25-2. The MPK now becomes MPK times 1 minus tau. So the MPK shifts inwards. Since it shifts inwards, you invest less. So the corporate tax deters investment, not surprisingly. Okay. The cost of investment haven't changed. The benefits have gone down. So corporate tax deters investment. But that's not all the corporate tax does. the corporate tax also allows depreciation allowances and investment tax credits. Let's say that the PDV, that Z equals the PDV of depreciation allowances. Remember I said each machine comes like a little sticker on it? The sticker says, here's what the PDV of your depreciation allowances are. So if it's expensing, that's 1. Okay? So that's the PDV of depreciation allowances. And let's say there's also alpha, which is an investment tax credit. So alpha is a number less than 1. That's the percent of your investment you can take off as a tax credit. Okay. Well, now what happens to your decision? Well, the cost of your investment has just fallen. The cost of your investment is no longer delta plus rho. The cost of your investment is now delta plus rho times 1 minus tau z minus alpha. Delta plus rho times 1, I'm sorry. Let's talk through this for a minute, okay? And the math is a little bit ugly here, so let's talk through this. This was your old cost. That cost is lowered by 2 factors, okay? Right. So basically what happens now? So you used to pay 20 cents. Well, now, first of all, if there's a 10-cent investment tax credit, then your 20 cents is back to 10 cents. Let's ignore this piece and just do the easy piece, so it's investment tax credit. Okay? It's 1 minus TZ minus alpha. Okay? Let's just imagine that TZ is 0. Okay? Then basically, delta plus rho is lowered by the amount of the tax credit. Okay? But, let me see, I think, did I get the math wrong here? 1 second. Right. For every dollar, you get alpha cents. Right. Okay. So that's taken off. In addition, you also get a depreciation deduction of an amount Z. That Z, however, that's only worth tau times Z to you because this is a deduction and this is a credit. So the deduction has to be multiplied by the tax rate. Remember, deductions are only worth less than credits. So the total marginal cost has fallen both because you're getting the deduction and because you're getting the credit. So the total marginal cost has fallen from in figure 24-4 from the blue line to the red line. The marginal cost has fallen. So corporate tax is doing 2 things. It's lowering the benefits of investing, but it's also lowering the costs of investing through depreciation allowances and investment tax credits. As a result, you end up with an uncertain impact on investing. In this case, you end up with still there's less investing. But you could imagine parameters such that actually investment could go up. With a big enough depreciation deduction, a big enough investment tax credit, you could actually imagine that investment could go up. So it's an ambiguous effect of the corporate tax rate. And that's why it's come, yeah.
So the investment tax credit is like, it's not based on your investment, it's based on cost of the investment.
It's based on the initial cost of the investment.
Not how much the investment is.
Yeah, I'm a little, so let's say you spend $1 on investment. Yeah, I think this is wrong. I think it's wrong in the textbook. I think it's outside, right? I think that's right. I think I got it wrong. Yeah, I think that's wrong. It's what's in the textbook, but I think that must be wrong. 1 second. Yeah, I will double check that and we'll post the right answer, but I'm pretty sure that feels like it should be outside of that parentheses because it's when you invest $1, you get 20-cent investment tax credit. No, wait a second, but you get. Yeah, I'll have to get back to this. It's a little tricky because the investment tax credit you only get once, whereas this is an ongoing cost. Let me think about that. What's that? It's investment. You get your investment costs 90 cents. Sorry, let me think for a second. You're buying a machine for $1. You have to pay every period 10 cents of depreciation, 10 cents of interest. But you only have to pay. Yeah, it's a little bit tricky because the investment tax credit is just the first year, not every year. I'll have to come back to this. I'll have to think about this. So I will post the correct math. Subject to the math. This is the way to think about it. But let's come back to the question that was asked back here. What this says is that ultimately we have to compute what we call an effective tax rate. That is, the tax rate on corporations is not TAW, because TAW, that doesn't account for the depreciation deduction in the investment tax credit. The effective tax rate in corporations we define as, it's just a definition, as the marginal product of capital after tax minus the marginal product of capital before tax over the marginal product of capital after tax. That is, it's a function of the wedge in marginal products that are created by the tax system. And if you do the math, and you guys aren't responsible for this math because I can't even get it right, so don't worry, you're not responsible for it. But if you do, let's focus on the intuition here. If you do the math, you get the effective tax rate is equal to TAW minus TAW Z minus alpha over 1 minus TAW Z minus alpha. Okay, that is the effective tax rate for a system of the type we wrote down. Once again, you're not responsible for the formula, but let's just talk about the intuition here. What this says is that basically if Z and alpha are 0, so there's no depreciation deduction and no investment tax credit, the effective tax rate is just TAW, right? The effective tax rate is the tax rate. But once there's depreciation deduction and investment tax credit, the effective tax rate is lower than the statutory tax rate. TAW is an upper bound. This comes to the question of what people pay. TAW is upper bound because of all these deductions and credits. And in fact, let's think about, let's imagine that Z is 0.5. Let's imagine that Z was 0.5 and no ITC. We'll get rid of alpha. If Z is 0.5, it's going to be 0.5. It's going to be, I'm sorry, TAW minus 0.5 TAW over 1 minus 0.5 TAW. With a 21% corporate tax rate, that is an 11.5% effective tax rate. That is, if Z is 0.5, the effective tax rate is half of the statutory rate. Okay, with a 50% depreciation, or let's go further. Imagine you could expense your investments. Imagine Z is 1. Then what's the effective tax rate? If Z is 1 and alpha is 0, what's the effective what's the effective tax rate? 0. Okay, if Z is 1 and alpha 0, effective tax rate 0. That is, so even though corporations are taxed at 21%, if they could fully deduct the cost of buying the good, it's effectively tax-free. Okay, so the effective tax rate is well below the actual tax rate. Indeed, if you look historically, and indeed, if you imagine a Z of 1 and an investment tax credit, you can have a negative effective tax rate. That's where going back to figure 24.4, you could actually see that drop in the marginal cost could be so large that investment could go up. In theory, with a large enough Z and a large enough alpha, you can have a negative effective tax rate. Okay, so basically, what matters to corporations is not the 21% or the 35%. It's what they end up paying, which can be a function of depreciation allowances and investment tax credits. When the corporate tax rate was 35% in the US, the effective corporate tax rate was about 18%. So the effective corporate tax rate pre the Trump tax cuts was about 18%. With the corporate tax rate now at 21%, the effective tax rate is now about 9%. So the statutory rate fell from 35 to 21, 14 points. The effective rate fell from 17 to 9, about 8 points. Okay, why? Well, because people weren't, the tax cut is as big, cutting TAW isn't as big a deal when you're getting a bunch of it back in Z and alpha. Actually, alpha is 0 now, so getting back in Z. Okay, so the statutory rate before and after 2018 went from 35% to 21%, but the effective rate went from, I have the numbers here, went from 17% to 9%. Yeah,
For the income or investment tax credit, is it just like investments in general, or can it be like used as a subsidy?
that's a great question. It can be set any way you want. It's a congressional, so you can set it any way. Same with, just like depreciation deductions can be set in any way the government wants. Investment tax credits can be set in any way the government wants. Okay, other questions about this? And once again, I'm sorry I'm confusing the math here. This formula is right, and this formula you're not responsible for. It's just to get you the intuition of how effective tax rates differ from statutory tax rates. Yeah.
Wait, so like based on like the original justification for like having a corporate tax, like what's the benefit that you get from having like a Z and an alpha versus just setting them both equal to 0 and then lowering the corporate tax?
Well, that's a great question. And the answer is that basically corporations can spend money on lots of things, right? Corporations can spend money on, go back to here. There's lots of ways corporations spend money. There's these and there's this. If you want to encourage investment, then setting those 0 and cutting the tax rate will not encourage investment as much as having a Z and an alpha will. So the idea is we want to encourage investment. And that's why I focus on those particular policy tools. Okay, so the question is, does it? And in fact, there's really good studies now because we've fucked around a lot with Z. If you look at the last 30 years, Z's been all over the place. By industry, by sector, over time. I mean, there's been just huge quasi-exponential variation in Z. And the estimates are that, measured correctly, that the elasticity of investment with respect to taxes is very high. It's above 1. So that basically there's a large efficiency cost to taxing investment. That if we have bigger Z's or lower TAWs or more alpha, we're going to get more investment and the response can be fairly elastic. Okay, so basically, you have a corporate tax where basically you basically have a corporate tax where it's more redistributive than income taxes, because at least half it's borne by capitalists, but not as redistributive as you think. And it's fairly inefficient in terms of deterring investment. So the corporate tax system is not as much of sort of winner as like the left would like to think. And we talked about that pie chart at the beginning in chapter 1 about how the share of taxes levied on corporations has fallen a lot. Well, it's not obvious that's a huge problem. Okay, and basically comes down to our friend the equity efficiency trade-off, which is taxing corporations is more progressive than taxing people. But remember, we tax people, we're taxing a largely inelastic factor. We tax corporations, we're taxing a fairly elastic factor, which is investment, which causes growth. So it's really, there's a very subtle, the argument pro and con corporate tax is pretty subtle. Okay, questions about that? What I like about this is it's a way of taking tools we've learned over 4 chapters and applying them to one specific example. Think about optimal policy again and coming to a conclusion which you wouldn't think someone like me would support, which is maybe we shouldn't have such a high corporate tax. Okay. Now, the problem is we've only done sort of the easy part of corporate taxation. The problem is the corporate tax is even harder because we haven't talked about international corporate taxation, the hardest and most boring subject in all of public finance. So we'll spend a few minutes on international taxation. I'll take just enough time to totally confuse you and then move on. Okay, so basically as we know, much of production is done by multinational companies. Companies that have subsidiaries in other countries is a typical way that goods are produced. Okay, so if you take General Electric, they earned in 2010, they earned 14.2 billion, of which 5.1 billion came from the US. Okay, so they earned 5.1 billion in the US, 4.2, but so they earned something, they earned more abroad. In that year, GM got a tax refund of $3 billion. Let me be clear, they earned 5.1 billion in the US in profits and got a tax refund of 3 billion. How is that possible? It's possible because of the problems we have with international taxing companies that operate in many countries. So let's talk about how that works and why it's hard. Okay. So basically, there's 2 ways you can tax money that's earned in other countries. two types of tax systems. One tax system is called a territorial tax system. A territorial tax system is that basically companies only pay tax in the country where it's earned. So company that earns money in different countries pays the tax in that country. Doesn't matter where they're headquartered. The other is what's called a worldwide system of taxation. A worldwide or global system where companies are taxed at home regardless of where the money's earned. Okay? So you can have a territorial system where GE is only taxed in every country they operate, or a worldwide system where GE is taxed at home regardless of where the money's earned. Okay? Now, traditionally, most countries in the world had territorial systems, and we had a worldwide system. That changed in the 2018 reform. And it changed because it turns out to be incredibly hard to carry out a true worldwide system of taxation. And that's because of the transfer pricing problem. That's because of the transfer pricing problem. Okay, so a transfer price is the price a company charges itself when goods and services flow from one subsidiary to another. And that price is set by the company. Okay, I mean, regulated to some extent, but sort of hard to regulate well. And that could lead to all sorts of shenanigans. Okay, so let's do an example. Imagine that the tax on corporate profits in France is 40%. And the tax on corporate profits in the US is 21%. Okay? Imagine further that an American company has a French subsidiary. And at that French subsidiary, they manufacture microchips for $100 each. I don't know why I make microchips in France, but just bear with me. Okay? Now, so in France, they make for $100, they make the microchip. They then send that microchip to the US, okay, where they add another $500 of other shit, you know, the computer part, the rest of the hardware, and they sell it for $1,000. Okay, so $100 of chips, $100 worth of chips made in France, $500 worth of other stuff in the US, you sell it for $1,000. Okay, now the US company could say that the entire $400 of profit was due to the microchip. That is, that the thing that made this profit was the microchip. Okay, the entire $400 of profits is due to the microchip. So it could say we are going to pay our French subsidiary $500 for every microchip, because that's really what it's worth, is $500. So what happens if the US company does that? Well, what happens if the US company does that is, if the US company makes that statement, that then the French subsidiary on paper makes a $400 profit. Why? Because it costs $100 to produce the chip, and they're getting $500 from the US subsidiary, from the US company. So the French company makes a $400 profit. Okay, and so so taxes in France are $160. Yeah.
Is the 400 from 1,000 minus 600 or from?
No, 400 is from 500 minus 100. It costs them 100 to produce it, but the US says I bought it. The US company says I bought the chip from France for 500. So the US company, this is the underlying math of production costs, but that math is seen by no one. Okay, the US company can announce what it paid its French subsidiary for the chip. So let's say the US company announced I paid $500 to my French subsidiary for the chip. I spent $500 more in the US and I made zero profits in the US. Okay, they're free to say that. This is unobserved. They can simply say, look, the subsidiary was worth $500. Okay, so I sent them $500 because that's where the profits really come from. Okay, so in that case, it'd be $160 to France and zero to the US. Yeah.
How can they just lie about?
No, they're not lying. The $100 is reported. The point is the $400 profit is magic. So they get to decide where it comes from. This could be the truth. Let's say that there's a perfectly competitive industry for this part, and they have a monopoly for this part, then all the profits would come from this part. It's not necessarily a lie, right? They're spending $500. The fact costs 100 doesn't mean they're lying. If this part's perfectly competitive and this part's a monopoly, then that's where all the profits would be earned. So it's up to them to decide where the profits are earned. So let's say the profits are all earned off the microchip, so you buy for $500. Let's say instead that they say, no, this is perfectly competitive. The chip's only worth 100. So profits are zero in France. Profits are zero in France. Zero French profits and $400 US profits. Well, what tax do they owe now? They now owe zero in France and 21% of 400. So 820 in the US. No, 82 in the US. Okay, so they just cut their tax bill in half, doing nothing real. By simply making a statement about which part of the transaction generated the profits, they've cut their tax bill in half. There is nothing here that, well, it's illegal, but there's nothing here which is sort of, there is no observably right answer here. Let me be very clear. The US company simply gets to announce where it's making its money from. Yeah.
I assume it's announced the same thing to both countries.
Yeah.
Okay.
Yeah. It gets, no, that'd be cheating.
Yeah.
It gets to announce it, but it gets to announce it. So as a result, there is nothing it is doing that's observably wrong. But it is technically illegal because the transfer price should recommend the true economic value of the good being transferred across subsidiaries. Yes.
You go even further and say that the chip was made out of glass, and then
You could absolutely do that. You could absolutely do that. You could go even further. Now, to be clear, tax authorities are not dumb. So if you were a tax authority, what would you do about this? Yeah. That'd be pretty clumsy. Let's talk about a more specific way to do it. Well, yeah.
look at the price of the chips.
Yeah, you can look at other market transactions to try to, if you see these chips sell in general for $200 and GE claims they're paying $400 for it, then you know that's bad transfer pricing. So you can't do this in an unlimited way because there are market transactions tax authorities can use to discipline this. But they're hard. These are really complicated. I did the easiest, this is a pain in the ass, I did the easiest possible example. You cannot have an easier example than this, and look how hard it was. Okay, this is incredibly hard. And there's armies and armies of lawyers employed by the government, which means there's armies squared employed by the private sector, okay, to undercover ways to do this transfer pricing in a way to maximize their profits. And that's how General Equilibrium, General Equilibrium, GE, could end up having a $3.2 million tax rebate on $5.1 million US profits. Okay, so for example, GlaxoSmithKline is a big drug company. They sell the also drug Zantac. You may have heard of Zantac. They have they're based in the UK, but they have a subsidiary in the US. And this is before the Trump tax cut. So the US was a higher tax country. So what they did is they shifted their expenses to the US, the profits to the UK. And the way they did that was they basically paid a very high royalty rate. They said, yeah, it's true Zantac's produced in the US, but it wouldn't exist without the intellectual property that came out of the UK. We've got to pay them a big royalty for that intellectual property. So we're going to say we're going to have a big tax loss in the US because we've got to pay all this money to our UK subsidiary for the intangible value of that royalty. It's not implausible, right? So they report a big US loss and a big British profit. Okay, except they got caught, and they had a $3.1 billion payment they had to make up for this transfer pricing. Yeah.
Why was that illegal?
It's illegal because the market value of the royalty exceeded anything that's plausible. Basically, once again, so the market disciplines, you could say, like, look, there's no way the drug company pays anything like that for a royalty back to its parent company. And you go bust them. And then what they probably did is they probably then went and found emails which said, hey, let's cheat in this way. And then they got busted. That's typically the way it happens. It's kind of, there's sort of a regulatory action because it's obvious something go wrong. And then you get a permission to go look at the emails. And then guys usually brag about cheating on taxes and they get caught. Okay, so this is a huge piece of corporate taxation, is essentially dealing with international transactions. There's all sorts of fun examples. One of the most fun was Apple. Okay, in 2011, Apple made 70% of its $34 billion pre-tax profits in other countries. Okay, but the other countries, on that 70% of the revenue, 70% of $3.34 billion profit, they paid an average effective tax rate of 2%. Okay, why did they do this? How did they do this? Well, basically, they used the fact that they had a subsidiary in Ireland, which is what's called a tax haven. Many countries set themselves up to try to attract business with low corporate tax rates. Say, come do your business here. And in a territorial system, that's great. Territorial system where you only pay the tax local place, you all want to go there. But even under a worldwide system, you can exploit it. And the way it worked was the following. So basically, Apple made $34 billion in 2011 and reported that in Japan, they made only $150 million, which is nuts. Japan's like Apple's biggest market, one of their biggest markets. And yet Apple reported that they made $22 billion of profits in Ireland. They reported they made 500 times the profits in Ireland they made in Japan. Yeah, but they went even further. Okay, there's a company called AOI, Apple Operations International. AOI is a holding company that owns Apple's official onshore entities. It has no physical presence. It has 2 Apple employees in Cupertino, California, and 1 Irish employee in Ireland. Okay, but it's not incorporated in the US. Okay, as a result, AOI, which controls all the foreign profits for Apple, did not pay taxes for years because the way they set this up. This is just brilliant lawyers doing this and setting this up. They eventually got busted, and eventually Apple had to pay a huge fine. They was reported they underpaid US taxes by $74 billion. They've had to pay a lot of that back. Yeah.
So like countries like Ireland who like want to be tax havens, like it doesn't really seem to me that it attracts business. It just lets the company just put their profits in the country.
Well, that's a great question.
Yeah.
Is do tax havens, what's the point of a tax haven? If in fact you don't have to actually put the people there physically. Okay. And the answer is that if you take, like, for example, basically what companies do is they go to the countries and they say, look, I'll promise to put jobs here if you give me a special tax deal. Remember I talked about property tax breaks? It's an extreme version of it. Give me a special tax, so I promise I'll create these jobs here. So it's the way companies negotiate over it. But you're right. A lot of these tax havens, I mean, countries in the Caribbean are huge tax havens. There's not a ton of jobs, but there are some. There are some and they're high wage jobs. So if you go to Bermuda and a lot in Puerto Rico is all really high income pharmaceutical executives and insurance executives running tax haven operations in those countries. And they're rich and they spend money there. So it's good for those countries. I mean, there's no reason in Bermuda, you have an insurance company or a pharmaceutical company in Bermuda or for Puerto Rico otherwise. So their view is, look, if I'm making zero otherwise, as long as I get some jobs out of this, it's worth keeping a zero tax rate. Okay. So basically, there's all sorts, I talk about all sorts of shenanigans in the book. And basically these tax havens are a pretty big deal. If you look at the British Virgin Islands, US controlled corporate profits. So what US companies claim they made in profits in the Virgin Islands amounted to 1,000% of the island's GDP. So US companies claim they made in the Virgin Islands 10 times much as the Virgin Islands actually claimed their GDP was. Yeah.
Why don't countries just pay off this tax? It sounds like taxing is talking about.
Excellent question. Excellent question. That is why there's been a huge effort by the Biden administration to negotiate a worldwide minimum corporate tax. So the Biden administration has been trying to do is get countries to agree to set a 15% minimum corporate tax. The problem is, as I teach in 1401, cartels are incredibly hard to get together because once you've agreed, if one breaks away and goes to 0, they get all the businesses, or goes to 10, they make a shitload of money, right? Because everyone leaves and goes there and they still get 10%. So it's a pretty hard cartel to hold together. Okay, and once again, the problem with any international agreement, from problem global warming to et cetera, there's no international enforcing body. How are you going to keep it together?
Yeah, I guess just to follow up, what percentage of GDP is taxed?
Well, no, it's not that. The point is that just shows how ridiculous they are. They are a non-trivial part of the economy of these countries.
Right.
Okay, so this is not something countries want to give up. Yeah.
Wait, like in terms of like them like potentially like setting up like a cartel, is the idea that like these businesses will leave it to go to like a 10% country versus 15%, or just that they'll report profits there?
Well, once again, that's the big issue. It's something in between. And this comes to exactly one of the key debates in the Trump tax cuts. Okay, so let's cover that now. Okay, so basically, the bottom line is that the way the US dealt with its worldwide system was what we said is, look, we want you to pay the US tax rate, it was 35%, on all your income, regardless of where it's earned. But we don't want you to pay more than 35%. So here's how it's going to work. We're going to give you a foreign tax credit. So the way it's going to work is you pay your taxes to your country X. Then you come back to us and we will charge you 35% minus the tax rate in that other country. But we only know to do that once you repatriate the money. So in other words, if you earn money abroad, when you bring it back, we are going to hit you with the tax, which is 35% minus what you paid in that money in other countries. So what incentive does that leave? Yeah, keep the money abroad. And that was the huge complaint about the US tax system, that countries had huge amounts of money abroad that they weren't bringing back to the US. Okay, and that was costing jobs in the US. Okay, so basically the idea was that essentially that all this huge stock of money, other countries were keeping this huge stock of money abroad because by repatriating they pay the US taxes. And if we got rid of our worldwide, so here is the argument for going to a territorial system, which we did in 2018. The argument was in two pieces. Piece one was our worldwide system raises no money anyway, because no one brings the money back. So yes, it's true. We should get 35% minus the other country's tax rate, but we never do because no one brings the money back. Plus, there's a distortion, which is all this money sitting in other countries could be coming to the US. So actually worse off. You'd think a world system would be better off. You'd raise more money, but they're arguing, no, you raise no more money because no one's stupid enough to bring their money back. And that money's sitting abroad instead of sitting in the US. So that was the argument for why we should move from a worldwide system to a territorial system. What's the counter argument? Well, the counter argument is of 2 points. One is, well, some of the money did come back. Okay, it's not like everything earned abroad stayed abroad. So we did get on net some tax revenue from a worldwide system above a territorial system. We did make more tax revenue with the worldwide system than we make with the territorial system, because some did come back. Okay, so it's not like it was zero coming back. The other argument is, who gives a shit where the money is? It's just in some bank. We're not talking jobs, we're talking dollars. As Paul Kroom wrote this very eloquently, that you could have US corporations that literally have the money in the same bank. One account is labeled, this account lives in Ireland. One account is labeled, this account lives in the US. Who cares? That it doesn't really matter where the money sort of lives. What matters is what companies do with it in terms of creating jobs and stuff. And except for the small number of jobs they're creating in Bermuda to run their tax haven, most of the jobs are where this stuff's produced. So the counter argument was, yes, it's true, the worldwide system is not doing what it's supposed to do as effectively, but it's still raising some money. And there's no real cost, because who cares if the money lives abroad or here? It's not like this hoard of gold you bring over on a ship. Okay, it's just a label for an account. And it shouldn't affect where people get hired, except for some modest effect, the effect you got to hire a couple guys in Ireland to run your tax haven. Yeah.
If they like needed that money to pay wages or something for people that work in the US though, wouldn't they have to bring that money back in?
Yes, that's true. They would have to. It's big enough tax, they just borrow in the US instead. Especially low interest rates. Why bring it back and pay tax rate? You just borrow it. You've paid a 2% tax and it's 35%, 33% tax, bring it back. You might as well just borrow in the US instead. Okay, yeah.
Would that also affect you as someone's frankly having to bring their money back?
Well, no, it's basically, it's related to this point. The money is just some money in a bank account. What affects consumption is wages that are paid out. And basically the question is, will it affect hiring? And the answer is no. Apple's worth $75 billion. Doesn't matter if that money's labeled as an iron or labeled in the US, they're going to produce goods where it's most effective to produce them. And that's what's going to determine consumption. Now, once again, not fully. So in some sense, here's kind of, it's like I said, this is hard. It's more interesting now explaining than I thought, but it's still hard. It's just as hard as I thought. Okay. which is basically, we think of worldwide taxation as having a big cost and a big benefit. We think of worldwide taxation, I'm sorry, as having the opponents of worldwide taxation described as having a big cost, which is the money lives abroad, and no benefit, which is we don't get any money, we don't get any tax revenues. They're wrong on both fronts. There is some benefit because we do raise some tax revenues, and the cost in terms of jobs isn't that large. That doesn't mean it's still a good idea. It just means the argument isn't as obvious as it was. Okay, and but nonetheless, that was a strong enough argument that basically, and actually we've done studies. What they've done in the past, they've done something called tax holidays. They said to companies, look, we know you have all this money abroad, we'll let you bring it back one time for a special low tax rate. And they studied what happened. It didn't create any jobs. They just changed bank accounts. Yeah.
So if they want to maximize the revenue, like from the worldwide system, and they're considering whether to go to a territorial system back in 2018 versus another option, would another option just be to say, we're going to crack down a lot more on companies?
Well, that would be, yeah, that would be the other option. The problem is it's really, really hard because basically any lawyer the government hires, the private sector hires two smarter lawyers. It's just really, I mean, I've worked with government lawyers and private sector lawyers, and private sector lawyers get paid 5 times as much and they're better. You know, I mean, that's just kind of the way it goes. So it's just it's hard for government to outthink people whose livelihood depends on outthinking the government. And so it's just really hard to do it. And that's why economists for a long time have said, we've got to stop fighting this fight and move to a territorial system. So that's what we did, move to a territorial system. Now, let me talk about one other thing about the Trump tax cuts. The Trump tax cuts were the most consequential change in corporate taxation maybe ever. Okay, so a big thing they did, they moved to a territorial system. That was one big change. The other big change was lowering the corporate tax rate from 35 to 21%. And the argument was, look, we were actually well above the typical worldwide tax rate. And they're saying, regardless of whether it's worldwide or territorial, if we want to compete for corporations in the market, we need to have a lower tax rate. In other words, they were arguing as a wedge, a tax wedge, in terms of where companies chose to locate based on our higher corporate tax rate. And that they want to remove that wedge by bringing from 35 to 21%, bring ourselves back in line with a typical developed country. Okay, now it's the argument. Here's the problem. That's not the only wedge in the tax system. Remember, I mentioned that a significant amount of production in the US is done by non-corporate entities. Non-corporate entities are taxed at the individual tax rate, which happen to be about the same as the old corporate tax rate. So before the Trump tax return, you're pretty indifferent. If you're setting up a company, you're pretty indifferent about being non-corporate or corporate. If you're non-corporate, you paid the 39.6% top personal rate. If you're corporate, you paid 35%, pretty close. But now, if you're non-corporate, you pay 39.6. If you're corporate, you pay 21. So we open up a new tax wedge. We used to have no tax wedge between corporate and non-corporate, and a big tax wedge between US and other countries. By closing the tax wedge between US and other countries, we open up a new tax wedge between non-corporate and corporate. Yeah.
When you say non-corporate, just want to clarify, it means like you just report as your own personal.
Exactly.
And so in the top one is
a doctor's office is a classic example.
Okay.
A doctor's office is a classic example of a non-corporate entity.
The top percent is 39.4.
39.6. Yeah. Yeah.
What's the non-corporate tax for like the other developed countries that you mentioned?
That's a good question, but that doesn't matter because non-corporate entities don't move internationally. Only corporate entities are shopping internationally. Non-corporate entities aren't, so it doesn't really matter what it's in other countries because there's not an elastic margin. Doctor's offices aren't competing. Setting up doctor's office in Bangladesh, it's not going to happen. So it's really just about corporations. Yeah.
Now, like the foreign corporate tax is higher than US, the FTC will give a subsidy to.
Well, no, we got rid of this system. We don't have the FTC anymore because we moved to a territorial system. Yeah. That is a great question. And the answer is it's not clear we care. I just described two wedges. I said we closed one and opened up a new one. Well, the one we closed is a good argument for why you care, which is corporations might literally settle in other countries to produce there. Why do we care? To incorporate in the US costs like $300. Why do we care? And the answer is not at all clear that we do. Okay, that led to the very worst part of the Trump tax cuts, which is nonetheless, the Trump tax cut said we also have to cut the non-corporate rate to get rid of that tax as wedge as well. Now you might say why, and the answer is there's no real reason. But the idea is, well, it's not fair that now GE is going to pay 21%, but my doctor's office is going to pay 39%. That's not fair. We're going to bring doctor's office down to 21% too. Now, they said, look, we understand we want people to be taxed a lot on their wages, but the non-wage part of the doctor's office. So anything they earn that's like their return to capital and stuff. Basically, essentially the argument is, here's a stronger form there. I'm being too glib. Here's strong for the argument. We don't want to distort where capital's allocated. Here's a strong for there. Right now, there's no distortion. Before the Trump tax cuts, capital's indifferent between being in the non-corporate and corporate sector. Now we're going to bias capital towards flowing to the corporate sector. Those people aren't going to invest in doctor's office anymore. They're going to invest in GE. So that's the argument. So that's actually, it's a more legitimate argument than I made it out to be. Okay. So what that says is, gee, you're worried. You get rid of one tax wedge, you open up a new one. Now, the right way to think about it in 1441 terms is, well, what's the elasticities? What's the elasticity of moving across countries and how big it costs? What's the cost of that? What's the elasticity of moving capital across sectors and what's the cost of that? Okay, so basically what Trump said is, what the Trump reform did is said we also have to address this tax wedge we've created in the non-corporate versus corporate firms, but for capital only. So we're going to set up a new system where in the non-corporate sector, your wages will still be taxed at the old individual rate, but your non-wage earnings will now be taxed at 21%. The problem is, how do you tell what's what for a doctor's office? Doctor can decide what wages to pay them. It's a transfer pricing problem again. So essentially, in the limit, with a good lawyer, a doctor's office can say, doctors say I make $1 a year, and all the rest is non-wage, and can lower their tax rate to 21%. Yeah.
Why don't they just cooperate, like for a doctor's office?
They don't be subject. Why don't they just become a corporation? They could do that, but there's a lot of wrinkles. I don't know the wrinkles exactly, but it's not quite as simple as that. But they could. So basically, what the idea was. So once again, this is very confusing. A lot of ins, a lot of outs for the Big Lebowski fans. Okay, but basically, the way to think about it is, you've got these two tax wedges: U.S. versus other countries, corporate, non-corporate. By fixing one, we made the other bigger. It's not clear why we care about the other, because doctor's office could incorporate, or why do we care? Well, let's say we do. Okay. Well, then they tried to fix that one by allowing a lower tax rate on the non-wage earnings, because they created a new problem, a new wedge, which is the wedge between wages you earn in a doctor's office and non-wage earnings in the doctor's office. You can't. It's a chase the incidence problem. The bottom line is, of the 1.5 of something like the 1.5. Let's see, I have the numbers here. Something like half of all the cost of the Trump tax cuts was this part about non-corporate entities getting a lower tax rate. Who are the non-corporate entities? They're the very richest Americans. It's doctors' offices, it's auto dealer owners. It turns out if you look at who are the top 0.1% of Americans, is a great study that does this. Very few of them are athletes and investment bankers. It's mostly physicians and small business owners. Okay, and they are the rich Americans, and they are the ones who got the big tax break from this reduction in the non-corporate sector tax rate. So essentially, as a result, the Trump tax cut both cost about twice what it would have cost if we hadn't addressed this, and all the benefits went to the top 0.1% of Americans. So if you look back at, I'm inclined not like things Trump did. Basically, other than this piece, the Trump tax reform, corporate tax reform, was not a bad piece of legislation. We probably need to lower our corporate tax rates. Probably made sense to move towards a territorial system. A lot of it made sense. It's just they added this last piece, which cost a huge amount, which is incredibly regressive and wasn't really necessary.
Wouldn't there already be a wedge to begin with, because you have all of these benefits for the tax rates?
Yeah, but doctors' offices don't have a lot of investment in depreciating and stuff, so it's not that different. Okay, like I said, like I promised, super confusing, but hopefully modestly interesting. And it just talks about the difficulties of taxation in the sector. Yeah. What's that? Yeah, definitely not.
But like, what do you think that they were thinking was the benefit of dropping the?
Oh, it's 100%. 100%. These are our voters.
I mean, there were almost no economists who supported that piece of the, there are almost no economists who supported that piece. Yeah, I mean, basically the rest of the law had a lot of support. So for example, the Trump tax cut, one thing I mentioned when I talked about income tax, I talked about the state and local tax deduction. Let's go back to chapter 18. I talked about how Haig-Simons would say you wouldn't want to let people deduct all their state and local taxes because they're partly getting a good for that. And the economists said for years we shouldn't allow that. The Trump tax cut limited the state and local tax deduction. Now, he did that just to piss off blue states, did it for the wrong reason, but it was the right thing to do. It's actually, in many ways, a very constructive tax bill. It's just this last piece was just a huge expensive giveaway. Okay, so that's where we are. I'm going to stop there. We're going to come back and do the last chapter. So bring back your handout from chapter 24. We'll do the last part of chapter 24 and then we'll bring hands for chapter 25 on Monday. Okay, please fill out your evaluations. Thanks.